to the Inspire Wealth podcast with Prof, where we dive into the world of real estate investing and wealth building strategies. I'm your host, Mallory Meehan. I'm a real estate professor, attorney, and seasoned investor here to guide you through the ins and outs of creating wealth through real estate. If you're looking to take your real estate knowledge to the next level, don't forget to subscribe to stay up to date with our latest episodes and offerings. Welcome back to another episode of Inspire Wealth. I am Prof M, and today I am joined by Ryan Chaw. Ryan, thank you for being a part of the show.
Yeah, thank you for having me on. I appreciate it.
Awesome. Well, Ryan, I know we were talking a little bit beforehand, but why don't you introduce yourself, tell our audience a little bit about what you do and what your specific niche is in investing.
Yeah, so I'm a pharmacist, actually former retired pharmacist now. I basically invested in real estate on the side of my full-time job because I wanted to have more flexibility with my time, flexibility in my life. I wanted to basically be able to live life on my own terms. And I was inspired by my grandpa who bought real estate in the Bay Area back in the 50s. And as we all know, real estate prices skyrocketed. Rents went up a lot, like crazy. And he was not only able to help like retire early himself, but also able to help me and my brother in paying for some of our college tuition. And I'm, forever grateful for that. But it really shows you how real estate can create that generational wealth. It started with my grandpa, and now I was able to purchase basically one property a year using this student housing model that I created where you just, rent nearby a college and you rent out each rooms to students or healthcare professionals while being able to create like affordable housing for that group. And obviously, as a real estate investor, you'll make more income by renting by the room.
I love that. And, me living in a university town, that's definitely something that I'm very familiar with as well. But I think you have a really cool niche that you're going after. So I love the fact that you bought a property every year and you didn't try to scale too quickly. So why don't you tell us a little bit about your first rental and then maybe some like lessons that you learned from that you're now employing in your future rentals?
Yeah, so my first rental I bought in 2016. It was $262,000 in Stockton, California. It was near my alma mater college where I went to pharmacy school. And I was inspired by my friend in that area during college. He bought very close to the school and rented out to his college buddies. And not only was he able to cover his living for free essentially. He was able to make some cash flow on top of that, to pay for tuition and everything like that. So I was like, wow, this works. This is really cool. So I bought my first property and I added extra bedrooms to, really increase the rental income I could make on the property. So if I, let's say, increase it to 6 bedrooms and I rent out each bedroom for 700 a month, that's typically around $4,200 a month for that property. And so what I did is that first one I bought, I obviously made a lot of mistakes. I had a sewage system issue. Basically, I got a call around, I think it was like 10 or 11 p.m. at night. And he was like, dude, there's like sewage bursting out of the kitchen sink. It's all over the floors. It's backing up in the showers into the bathroom floors as well. And yeah, it was really horrible. So we had to get like a proper sanitation crew out there. And then I had to get a plumber as well to scope the line, figure out what was going on. Looks like the whole line was actually broken because of the roots from the trees nearby the house.
Mhm.
And so I had to replace the whole line, which was I changed it to PVC, and which is more durable than like cast iron.
Mhm.
And it cost me $9,000. But I realized later on that I could just do a sewage line inspection when I am purchasing the property, which will actually just scope the line out for like 200 bucks. And if I found the break then, I could have asked the seller for credits towards that repair. So I learned my lesson there, really doing your due diligence. I also had like a party tenant. And so I learned how to vet tenants a little bit better.
Mhm.
That party tenant was actually my in the same fraternity I was in, and I knew that he was kind of a partier. He was very loud and he caused a lot of trouble, I would say. So yeah, one night he invited over like 80 people into the house. And then I was like, oh my God, I got a call from one of the housemates and he was like, dude, do you know what, he just did? He invited over 80 people for a crazy Halloween party. I'm not okay with this. And so, I had those types of issues when starting out. But over time, I learned how to invest in universities where you do get a higher quality set of tenants. Specifically, I target and look for like graduate students, professional degrees, if possible, or at least colleges that have professional degrees. And I also look for houses nearby clinics and hospitals so that I can bring in people like travel nurses or medical interns, residents, and fellows. And so that really has become kind of my primary client base. And I have about 90 tenants right now.
I love that. That's awesome. So, a lot of lessons learned from your first property. Now, I'm interested to understand when you are buying a new property, like tell me about that process. Like, what things are you considering? I know you said due diligence, but are you
Mhm.
setting aside a specific amount of reserve so that if a sewer does, a sewer line, excuse me, if a sewer line does
Yeah.
go, you at least have some backup. So tell me more about, let's say you're looking at a new property now and maybe even a new town that you haven't invested in. What kind of steps would you go forward with looking and evaluating that particular property?
Yeah, definitely set aside some funds for emergencies. If you're in real estate, there's a lot of things that can happen on a house that are not necessarily always predictable. Obviously, you can find certain things on the home inspection, like the sewage line issue. You can actually get a sewage line inspection for that. But you do have to have money for real estate, like some capital saved up. There are some people who say, like, oh, yeah, you can go in with zero money down and all of this. I don't think that's very safe. I think you should have the down payment plus at least like $10,000 to $15,000 in emergency funds. That's because like if your furnace blows out in the middle of winter, it's going to cost you like 10,000 or like eight. I would say 8,000 to 10,000 to replace that.
Mhm.
And if your roof goes down and you have to replace your roof, that could be up to like 15,000 or more. So you just have to realize if you're getting into real estate, it's a great way to obviously make a lot of income from it, not just through cash flow and appreciation, but your tenants are paying down your loan and all of this. But you also have to be in a position where you have a good amount of money saved up to before you invest into it.
Yeah.
So that's like, yeah, one lesson that I learned is really what I did is I worked a lot of overtime at my hospital position, and I actually had two jobs as well. So I worked retail pharmacy and hospital pharmacy to save up for that initial down payment, and that's kind of what helped me become successful later on, especially.
That's awesome. So your first property you saved up and you have all this money. And then tell me how you then began scaling. Did you continue working both jobs and just did the same process over, or were you leveraging things from your initial properties? Tell me about that process.
Yeah, so what's cool about real estate is because of the appreciation and all of that equity that's being put into the property by, your tenants paying down the mortgage, after around year 3 or 4, what's nice about it is you usually build up enough equity to purchase another property. So for California, for instance, if the appreciation is about 7%, which it was historically, 7% per year. Now, most appreciation ranges from 3% to 7%. But I invested in California and it goes up about 7% per year. So after 3 years, it appreciates about 21%. Well, my down payment is a 20% down. So if my appreciation was 21%, that means I doubled my down payment. So every like few years, 3, 4, 5 years, basically what happens is you double your down payment, and what you can do is take out some of that equity or leverage that equity that you build up into the property using a HELOC or a cash out refinance and to purchase another. So I bought one a year for the first like 5 years. But what I was able to do in year 3 or 4 is start using like HELOCs to leverage some of that equity to buy more property without having to come out of pocket on it. Now, yes, you will have to pay, an interest rate on the money you take out, but it's very nominal to how much cash flow you would be making if you did this strategy. Now, I can't speak for other strategies out there, but this one, if you're, let's say making 4,200 on a 6 bedroom house, your mortgage payment being like 2,000 a month, your take home is still a good amount, like 1,500 to 2,500. I think my highest one is making about 4,200 a month and like cash flow after expenses. So
Wow.
it's just like it's a really exciting, powerful strategy that you can use.
Yeah. So when you're looking at doing the HELOC, like how many times have you done a HELOC on some of your different properties?
4 times, I believe. Yeah.
Okay. All right. Well, that's
So
awesome.
yeah, definitely. And then what I do is like once I buy these properties and they're making cash flow, I will either reinvest the cash flow or use it to pay off the HELOC as I go along. So if I'm not actively buying a property, I would just stick that money into the HELOC because I can always take it back out the next day. HELOC is a very flexible, it's called a line of credit. It's basically kind of like like a very low interest rate credit card.
Mhm.
You're only paying, I think nowadays it's like 8% or something like this, but you're only paying 8% on whatever money you take out. And if you don't take out any money, you don't pay anything, right?
Right.
So if I keep my HELOC at $0, I don't really need it, then I don't pay any interest. So that's what I do is I will leverage the money when I need it, the HELOCs when I need it, and then I'll basically pay off the HELOCs with the, 2,000 a month in cash flow coming in
No, that makes
for the
total
house that I
sense.
bought. Yeah.
All right, so let's change gears a little bit and tell me about the markets that you're currently investing in, and then maybe give me some ideas of like key indicators of new markets that you might be looking at when you're evaluating specifically for students or, medical professionals.
Yeah, definitely. So I'm in California. I'm in Sacramento and Stockton, California, and I'm also in Ohio, Cleveland, Ohio. The main thing you really have to figure out at the beginning is do you want to go for cash flow or appreciation? Because cash flow is really good if you want to replace your W-2 and leave it as soon as possible. But appreciation is where your net worth is really created. As I mentioned, with appreciation of like just say 7% per year, you're doubling your money every 3 years. Stock market, obviously, I mean, yes, maybe there's some individual stocks, I don't know, Nvidia or whatever that will go up like crazy, but in general, it's very hard to like just double your money every 3 years. But real estate can do that, and so. Like you really make a lot of wealth through the appreciation, way more than you'll make in cash flow. But it's up to you. Like, are you going to look for a house that's going to cash flow more or appreciate more? For me, I started off with appreciation, obviously, because I invested in California. So first figure that part out. If you're going for higher cash flow markets, usually you'll look for houses in the lower median home price range. So I would say anywhere from 200, 250,000 up to 350,000. Usually that's a really good spot to be in if you want a high cash flowing property using this method. Now, the other thing I do is I will look for top colleges. So I will literally go to the US News top colleges list in whatever state that I'm looking to invest in. And I will look through each of those colleges and I will compare the different cities, what the median home prices in each city is. And I will usually choose to invest near a top college that has a lot of grad programs. So I'll look for things like pharmacy degrees, degrees being offered, medicine, nursing, MBA, law degrees, engineering degrees, basically any degree that requires you to study really hard and work
Mhm.
really hard for that
Yep.
degree. And that usually ends up bringing in then the best quality tenants from my experience. So yeah, I've definitely come a long way from, having like a party tenant I mean, I think I've maybe only had like 3 house parties that I know of at least for the last 8.5 years. So yeah, investing near the top end college is number one. Number two, I would say is you want to have a house that's within either a 5 minute drive distance or within walking distance to campus. Now, if there's a shuttle stop, that's great as well. Like if you have a shuttle stop and it's only a 10-minute shuttle ride to campus, usually that also works. But I usually try to be as close to the campus as possible because a lot of students, they value convenience over everything everything else. They want to be as close to their classes as possible. So I buy within a lot of times like walking distance or shuttle distance to campus. And I'll also look for houses that are larger houses so I can get those extra bedrooms in. I try to aim for 6 bedrooms. I find that's a really good number without feeling like too crowded. But at the same time, like a group, like a tennis team or something like that, could bring in their 5 other buddies and live at the house together versus having to split up into separate apartment units. So it fulfills that very specific niche. What's also cool is we're also affordable. So I have to make sure I charge the right rents that make sense for what a bedroom will charge. So I do my market research for that. But because I'm only charging, let's say, $600 or $700 per month in a market where the on-campus housing is like $1,200 per month or more, I'm like literally cutting their rent in half. And so they're saving a lot. They have to take out less student loan debt, it's a lot more affordable, and it's also very close to campus. So it makes sense for a lot of students just economically and just overall, like they have more privacy compared to the dormitories, and they're paying way less, right? So I think those are the things that some of the key factors that I keep in mind.
No, that's great. So, talk to me a little bit about your tenant screening process. So, I know that, you had a party tenant and now you're kind of looking for those more professionals. What's something that if people are looking to go into this type of strategy, what are some things that they should be looking at before they sign a lease with any of these individuals?
Yeah, I think a big part of it is like looking about like how do they behave? Are they like in their emails, are they addressing me like, oh, hey, Dr. Chaw, I would love to see your property, etc. Or are they saying like, yo, what's up, dude? I want to move in tomorrow, all this type of stuff. I find that the tenants that are very professional and like anti-needy or, not very needy at the beginning, I find that they tend to be some of the better tenants as well. I do also like try to group people together. So like if there's like a pharmacy group or a lot of people in pharmacy, I'll try to make that the pharmacy house, for example. And I try to mix some students sometimes when, like, let's say there's a lot of, I don't know, sophomores or juniors, I might mix them with a few grad students because the grad students are usually a lot more, focused on their studies and they're not going to put up with like a wild house party or anything like that. So those are a couple things I do. I think the most important thing is investing their high-end college because they work their butt off to get into that college to get into that doctorate degree or professional degree, and so they're not going to, really like blow it. They're really focused on getting that degree that they paid for.
Yeah.
Oh yeah, another thing I would say I look for is I try to be near colleges that have like at least $15,000 a year in tuition. Just because if they're able to afford that, they're usually able to afford the rent as well.
Mhm.
And a couple other things I do is I do collect first and last month rent plus the security deposit. So it's kind of like almost 3 months rent up front before they move in. So they're less likely to just, leave without telling me. They're less likely to cause a lot of trouble and not pay the rent, all that type of stuff. So I do, definitely do that. I also, of course, make sure that they have proof of income. So having at least like 3 times the monthly rent coming in as income from their parents, from their student loans, their stipends, or financial aid. That's always a step I never skip.
Yeah, no, I think that's really, really important, especially for students, because, if they don't have a verifiable source of income, you at least have to know, okay, where's this money coming from?
Yeah, exactly.
Yeah.
And that's the question I asked them is like, is it going to be you paying for it or is it your parents? Like, what are you going to use to pay the rent, right? And
Yeah.
then whatever that source is, I asked them for documentation.
No, I think that's really smart. So I know when we were talking a little bit before, you told me that you have kind of like a head tenant or like a liaison, if you will. Do you have a property management company that helps you manage these, or what's your team or structure like? Because you have 90 tenants. I mean,
Yeah,
you want financial freedom. You don't want to have to be dealing with these 90 tenants every
exactly.
single day.
Yeah.
So tell me what your process looks like there.
Yeah, so having 90 tenants, obviously it's a little bit different than at the beginning when I was self-managing myself. Now, if you're just doing this and you have one or two or three properties, you can actually self-manage. It's not like rocket science, right?
Mhm.
You just have really good contractors that are available, like making sure to vet really good contractors and handymen that can go to the house in case of an emergency. But for the first couple of properties, usually it's not too bad to manage on your own. Once you start scaling, you definitely need to have more of a team. So I have like a bookkeeper. I think he works about 20 hours a week or something like this. And he's based in the Philippines, really good with math and bookkeeping. And I also have another full-time VA. Well, I mean, sorry, it's my first full-time VA in the Philippines. And he works on like customer service, marketing, talking to a lot of the tenant leads that come in, and vetting them and things like that. And so I have that as like I would say some of my primary team. I also have a local property manager who basically can help out with any of the tours. What I do is once a quarter, I'll have them go in with a checklist to make sure no leaks, the place is clean, all this type of stuff. And I provide them for that with that checklist, and they basically will charge me maybe like $60 or something like that for the visit to the house and fill out that checklist. So it's on a per cases basis that I pay them. But I do have my own marketing systems, a lot of automation behind the scenes, so I don't have to be responding to every message, nor does my, VA team have to respond to every single message. They kind of have a response that's already sent out, along with our application, our website, all of our pictures and everything like that. So that's kind of like what some of the back end looks like. Honestly, when I first started, I just used Excel spreadsheets to keep track of everything, like utilities, rent coming in, all that type of stuff. I just used an Excel spreadsheet. I looked at it at the end of the month. It took me maybe an hour or 2 hours at max. And yeah, the rest was just kind of like self-managing. But with that being said, yeah, like in my coaching program, for instance, I really do focus on creating those systems and teams and putting those in place because that's the key that's going to make sure that you can do this while working your full time. And I worked full time pharmacy basically for the 8.5 years. I briefly cut back to like 32 hours, but the first, couple years, I was working full time and overtime, 16-hour shifts sometimes, sometimes. So yeah, I was able to do it. I think anyone can do it.
Yeah, no, that's great. Okay, so let's talk more about your coaching program and how you help people maybe get into this specific type of niche and what people would get by hiring you as a coach.
Yeah, so I do have like a 6 month coaching program. And what we do is really focus on getting that very first rental because once you have the first rental down, it becomes a lot easier later on. With that being said, I do have some people who buy like two or three rentals in the first couple of months. So it's 6 months, and I work one-on-one with my clients. That's really like how you get the most value, I feel like, when working one-on-one with a coach. And so I provide all the systems and teams. I also walk you through from like market analysis, like how much can we charge in rent to be reasonable for the students in that area, to looking at specific deals, like what are the pros and cons of buying this one versus that one, and then eventually settling on a property that you'll purchase and renovate, like to create those extra bedrooms, and then market and manage it. And again, like having the systems in place was a huge game changer for me because when I initially started, I didn't have any systems and I had a lot of, mistakes made. I lost over $30,000. And so I guess my focus is making sure people just get that first one and get it done right because financial freedom is a long-term game.
Yeah.
You're not going to replace your salary in year one. That's why I like people, like I tell people, start now. Like there's no time to wait. The clock is ticking because you buy that first one, and then maybe for the second one, you have to wait a year because you're saving up some money for that second one. But eventually you reach this stage, maybe in year 3 or 4, where it's kind of snowballing where the equity is building up on your initial properties. So basically every single property you buy, you have another 40,000 in equity on them that you can take and, purchase another one. So it does snowball. And I would say after like year 8 or so to year 10 is usually when you can reach that financial freedom, only if you start now. So
Yeah.
that's why I tell people like you really want to get that first one like now. There's no time to waste because, this is going to be a long game. It's not like a get rich quick type of thing. It's like get rich slowly, but also very consistently and very predictably, and you have control over it too, right? You have control over everything when you're doing this investment versus like some company stock that goes up and down based off of the geopolitical climate and how the company is doing and all of that type of stuff.
Yeah, absolutely. I think that that's great. So, somebody who might be interested in getting into this type of investment and wants to learn more about your program, where can they go?
Yeah, so I provide a free PDF that goes through the student housing method, some of the strategies that I've used, and the mistakes that I learned when starting out in this niche. And you can get that at www.newbierealestateinvesting.com/guide. That's www.newbierealestateinvesting.com/guide. And then newbie is spelled Newbie.
Got it. No, that's great. So I like to always end with maybe a piece of advice or, something that you would tell. And I know you just said start now, don't wait. But is there any other piece of advice that you would give somebody who's maybe, they've been over analyzing things, they just haven't pulled the trigger yet,
Right.
they don't have the confidence. What are some of those things where these new investors, especially if they're young and they're eager, what's some advice that you would give maybe your younger self that you've learned over the years?
Yeah, honestly, I would invest in people, invest in coaches, invest in networks. I'm part of a network called like GoBundance, for example. Yes, it's $10,000 a year, but I'm more than willing to pay it because I do get a lot of value from that. Just surround yourself with people who are doing it because I would say the majority of people like in school and everything, I think you're changing that, right? But and the majority of people do not learn real estate and investing or tax advice even in school. They just don't know. School doesn't teach much about finances. And so you really want to get in touch with people who do it on a daily basis, daily real estate investors, uh, be plugged into those networks. There's a lot of real estate investing groups out there in pretty much every state, every city that I can think of. So get plugged in. I do recommend hiring a coach. If I hired a coach, I probably would have done things faster, been able to shorten my timeline, make a lot less mistakes, and usually that value pays for itself. And listen to take some courses from Professor Meehan, right? Professor M. And just try to learn as much as you can, but also work with people who, know what they're talking about and have a really good proven track record. Not somebody who's like on like Instagram promoting real estate, but they've only been doing it for a year, right? You really want to find people who have been doing it for a while, and so they've gone through the ropes and really have had that suffering and made those mistakes already, so that they can tell you how to not make those mistakes.
Yeah, no, I think vetting is definitely one of the most important things. You want to have somebody who has a credible track record, who, would be somebody that you would feel comfortable with, taking advice from and putting your money into an investment. So I couldn't agree more. So Ryan, thank you so much for being a part of the show. And I want to encourage everybody to take a look at Ryan's website. We'll leave it down in the notes. And if you like this episode, hopefully you did, give us a thumbs up and make sure to subscribe for all of our new content. And I am Prof M out. And for those who want a more hands-on learning experience, check out our online courses at inspirewealtheducation.com. Whether you're just starting out or looking to expand your investment portfolio, I've created step-by-step guides and resources to help you achieve your financial goals. So hit that subscribe button and let's start building your wealth one episode at a time.